calls. Covered calls are an option strategy that involves holding the underlying stock plus S and shorting a call against it, selling a call against it. Okay, so a little bit of backdrop here. Let's remind ourselves of the option payoffs that we've been talking about through previous modules here. Remember our kind of options diamond giving us our 4 payoffs. There's our longs on the top, our shorts on the bottom, calls on the left, puts on the right. Okay, there's our 4 option payoffs. Don't forget, the underlying is always the horizontal axis and P&L is the vertical axis, and there's 4 different charts there kind of placed next to each other. So what are we doing with a covered call? We're buying the underlying plus S and we're selling a call against it. That's a short call which is over here. Short calls are over here. So look at this short call exposure. It loses as the underlying asset goes up. What we're doing here is we're giving away upside. This loses as the underlying goes up. Whilst we're long the underlying, this thing that loses as the underlying goes up is going to take away the gains as the underlying goes up. We are forsaking upside in the asset in order to generate option income today. That's the general idea. All right, we are forsaking upside and generating income today. Now that income is the call premium. It's likely to be a very small fraction of the underlying's price. So, you know, we've still got quite a lot of exposure to the underlying on the basis that the premium is likely to be a small fraction of the underlying's price. However, this short call, its risk that the underlying goes up and we suffer big losses on that short call, that risk is mitigated by the fact that we already own the stock. So we've got a hedge from our short call position. We already own the stock. We're not writing what's called naked calls. We're writing a covered call here. We already own the stock, and therefore these unlimited losses on the short call position, they're not really there because we've got unlimited gains on the underlying as it goes up as well, and they cancel out. Okay, so here's an example. We're going to buy a stock, all right, plus S for 52.14. And here comes the short call position. We're going to sell 55 strike calls for 2.52 per share. All right, that's going to be premium income for us. If the underlying goes up above 55, the call will be exercised and we will lose money from that exercise decision. And that's what offsets the upside of the underlying asset above 55. As a writer of a call, don't forget though, we always keep that call premium. If the underlying is below 55 at expiry, the call is out the money, expires worthless, and we just keep the premium. Okay? Now, in terms of what the maximum upside, maximum gain, maximum loss here is for this particular position, it might be worth picturing what is going on using these kind of diagrams. We've gone long the underlying asset, long S. So that's going up. Don't forget the horizontal axis here is always assumed to be the underlying asset. That obviously trivially goes up as the underlying asset goes up and goes down as the underlying asset goes down. What we've done is we've sold a call against that. Now, your option diamond tells you that a short call loses as the underlying goes up. You keep the premium if the underlying goes down, but it loses as the underlying goes up. That's a short call position, the bottom left of the option diamond. If we bolt these two things together, we can see, so there's the strike there, we can see that to the left of that strike, what have we got? We've got a downward sloping line because we're still long the underlying asset, and we just collect the call premium there because it expires worthless. Don't forget we sold the call. So we've got a downward sloping line to the left of that strike. To the right of the strike, as we know, any upside in the underlying is given up through exercise losses on the short call. So we get a flat line there. Those two lines cancel out. You see that? So that's what a covered call looks like. Now, does that look familiar to you? It should look familiar to you. That's the bottom right of the option diamond. Okay, that covered call is very similar to this here. That sort of setup. All right, it is actually a synthetic short put. All right, now we finished the previous section. That's what a covered call looks like, a synthetic short put. So how does that work? Well, we finished the previous section by saying, do you remember we made a big deal about this? The previous section, which had put call parity in it, we said C minus P is a synthetic long. If you like, this synthetic long, it's a geared long position, but we're going to ignore, you know, the time value of money. We're going to ignore the cost of financing the position. We'll just call this S in inverted commas and assume that we've funded our position through a borrowing. We'll ignore the bond that we need to fund that geared position in the underlying. So when we do that, we drop the present value of X from the put call parity formula. Okay. Now if I rearrange this, what have we got? We've got, with a covered call is the underlying minus a call. Now if I rearrange this equation, that turns out to be S minus C. Well, I can take C off of both sides so that the minus C goes over there, and I'm just left with minus P on this side here. So that is me rearranging that neat little expression that C minus P is a synthetic long. If I actually go long and sell a call against it, what I'm synthesizing is a short, that's what the negative sign represents, a short put. Now you can either see that through the very basic application of put call parity, ignoring the present value of X, the bond that's used to fund the long position, or you can see it through basic diagrams like this. But this is what you're synthesizing with a covered call position, which is plus S minus C. You're synthesizing a short put position. And the best you do with this short position, this short put position, the best you can do with this net P&L is here. That's the best you can do when the underlying moves to the strike. That's your maximum profit, when the underlying moves to the strike. So when the underlying moves to the strike, in this particular case, it's when the stock moves to 55. You remember in this case that the strike was 55. Okay, don't forget covered call is long the stock, which was at 52.14 today, and sell a call, which we sold the call for 2.52. All right. So look, the maximum profit occurs when the underlying, they call it the stock here, when the underlying goes up or is at the strike price. Don't forget that dotted line is the strike price. So 55 is the strike. At 55, the stock has gone from 52.14 to 55. So your gain on the stock is 55 minus 52.14, which is where that 286 comes from. Any appreciation above that is given away on the short call side. You know, that's what we mean by these arrows cancelling out. These two arrows here cancelling out. The long S and the short call, they cancel out. So any appreciation above the strike of 55, you don't actually get. Your two positions cancel out. So this 286, that's the maximum you can make on the stock. Don't forget you still keep the call premium of 252. Okay, so there's your 286 from the stock going up from 52.14 to 55, plus the call premium, because you wrote the call, you collect the call premium, and it's not exercised when you're at 55, it's right at the money as they call it. That's your maximum gain. You can't do any better than that. Maximum profit or maximum gain. So that's the general rule here. If you want to work out the maximum profit under a covered call, just think what happens, what's my profitability when the underlying S moves to the strike price X. All right? At that time, S will move from where you bought it to the strike, and you'll keep the call premium because the option is expiring at the money and not being exercised. But you can't do any better than that. Your maximum loss here, well, you'll notice from the picture that there is quite a lot of downside still. In fact, all you've really done is stayed long the underlying asset where you could lose everything and then you just collect a small call premium against it. So you could lose everything here. You've bought the underlying for 52.14. You could lose all of that, all right? But you do still collect the call premium. So your overall maximum loss is slightly lower than just the current stock price. It's current stock price minus the call value, which is 49.62. That's your maximum loss here. The break-even. Well, the break-even, the way to think about the break-even for a covered call. If you think about it, you've brought some call premium in, haven't you? By selling the call, you've brought some call premium in. Now, you will break even on this position of S minus C when losses in the underlying wipe out the call premium that you've brought in. That's when you'll break even. You'll break even when losses on S that you're still long wipe out the C, the call premium that you've received in. Now, don't forget, the call premium is 252. When you lose 252 on something that you've bought at 52.14, don't forget we buy the underlying asset at 52.14, then you must be at 52.14 minus 252, okay, which is 49.62. Turns out it is the same as the maximum loss. The break-even is the same as the maximum loss. Okay, but I'm just putting a bit more colour on it there. You can always think about it as, if you haven't got the maximum loss in front of you, you can always think about your break-even when losses on the underlying position wipe out the call premium of 252. So that must be when S falls to 52.14 minus 252, which is the 49.62. Okay, so we know what a covered call is by this stage. We know that it's long the underlying shares, and we're going to sell a call against it. Okay, so plus S minus C, that is your covered call position. So we did allude earlier at the start of this reading to the reason why we might do this, but let's explicitly reference three key investor motivations for putting this position on. The first one, probably the most common one, is just simply generating premium income against a holding, an underlying holding that you don't expect to go up anytime soon. You expect it to stay stable. Now, when you're selling options, you don't expect things to be volatile because volatility causes option prices to go up. So this is a way of selling calls against an asset that you don't expect to be volatile and generating some income along the way, so generating some positive returns along the way. Of course, you're going to sell these options out of the money. So for example, if the underlying is at, say, 50, you're going to sell these options at, say, 55, something like that. You're going to generate some premium income, but you don't expect the underlying to go up above 55 and you to start being called on the option that you sold. So it's an out-the-money call that you're selling. You don't expect price appreciation such that the option goes in the money. The premium just generates some income in a static market. So I think that's the primary motivation for engaging in a covered call strategy. A secondary motivation might actually be using the call to exit positions at a target price that you're comfortable with as an investor. So don't forget, when you sell a call and it gets exercised, the asset does get called away. The person that has bought the call from you, the person that's holding the call, will exercise their right to buy and you'll have to deliver the shares out to them. So this is a way of reducing a position that maybe you're overweight. For whatever reason you're overweight, or maybe it's reached your target. That's when you might want to sell an in-the-money call. So maybe the stock's at 50 and your target price is, say 40, 48, something like that. So you're comfortable selling. So maybe sell an option with a strike price of 48. You do expect the market not to be volatile. You expect the market to be stable. That's a key point here. So the stock's going to stay around 50. That's your expectation. And you expect the option to be called. You expect the option to be exercised and this underlying stock to be called away at 48. So what's the motivation for doing that? Well, really the motivation is that it generates income. Selling the option generates income. And in a stable, static market, the option decays in value. And yes, it gets exercised, but the time value of the option decays away. The risk, of course, is that the stock price decreases. Maybe it falls sharply back to 40 and you've missed your exit. The option doesn't get exercised at 48, obviously. You've missed your exit. Yes, you generate some call premium income, but that's not a great amount of income relative to the price fall that you've experienced. So, you know, the downside to trying to reduce a position by selling in the money calls is that actually the underlying falls. You don't expect it to, of course, but the underlying falls, and whilst you collect the premium, you fail to exit your position at your target price. You miss that opportunity. The other downside, of course, remains that if the stock unexpectedly shoots up in price, then you miss out on that. You miss out on that gain. A third motivation might be selling a slightly out the money price, similar motivation to number 2, but you're realizing a target price here as well, but that target price is slightly out the money. So maybe you're, once again, the underlying is at say 50, and you're selling an option with a you're selling a call option with a strike of 51, say. So that's slightly out of the money. You expect the stock to move up. It's not going to be a massively volatile market, but you do expect the stock to move up, hit 51, and when it does move up to that level, you are happy to let the stock go because the call would be exercised. Once again, the risk here is that if the stock price shoots up a lot, then yes, you do not participate in the upside because the option will be called at 51 in my example. And the opportunity to sell at high prices, well, that would be if the stock price falls. Once again, if the stock price doesn't go up to that target price and it falls back sharply, you're still exposed to that downside.